Hello, listeners. My name is Raj Singhal, and welcome to the episode of Breaking Investment Stereotypes. This episode is brought to you by Multipie.co, where we believe that investing is an ignored life skill. Our mission is to create a platform where people can come, learn, share, and collaborate through the right tools. Ultimately, we want your hard earned money to work for you. Here at Breaking Investment Stereotypes, my job is to deconstruct world class investors or wealth managers, deep dive into their investing journey and habits, and how they've broken the stereotypes in this seemingly complex world of investing. For those who don't have a context on me, I was last working as MD and CEO for Southeast Asia at Bank of America, where I worked for a couple of decades. I've been a macro trader all my life and managed my own investments all the while. Investing really excites me, but I had to learn the hard way. I had great mentors for my career, but never had one for managing my money, or let me say, I never looked for one. So, what we want to do here is to help you untangle the world of investing. We want you to develop skills so that you can come and you can manage your investments well. Just a bit of a guidance on how to use the show. We're not giving financial advice, we're not giving any stock tips. I don't believe people listen to stock tips, and I sincerely believe that people are better stock pickers only in hindsight. We are here to give you principles to be used for investing. So please treat everything we discuss here as public opinion. So without further ado, I would like to introduce you through our interview, our guest, Kalpen Parekh, whom I have known for 20 odd years. Kalpen Parekh is the president of DSP Investment Managers Private Limited. He has over 2 decades of experience in finance and asset management. Prior to joining DSP, Kalpen was responsible for growing businesses at IDFC Mutual Fund, Birla Sun Life, and ICICI Prudential Asset Management Company. Kalpen is in the podcast because he is a deep thinker and he's passionate about behavioral science and believes that investor behavior is one of the most crucial aspects to a great investment experience. He has a very popular Twitter handle in his name. He holds master's degree in management studies in finance from Nursi Monji and a bachelor's in chemical engineering. Most importantly, he belongs to DSP family like many of us. I started my career in '96 at DSP Merrill Lynch and have some very fond memories of the place. So, without taking much of your time, please enjoy Kalpen Parekh. Kalpen, welcome to the show.
Thank you, Raj. Happy to be a part of this. And I really loved the way you set out the introduction for your own company. Very differentiated and extremely valuable life skill, as you mentioned. So I hope I'm able to add some insights and value to your listeners.
Thank you, Kalpen. So let me actually start with one of our favorite books, and I see that you tweeted quite a few times on that. The book is called. It's a very popular book, especially on Twitter right now. It's called Psychology of Money by Morgan Housel, which is basically a study of how people behave with money. It basically talks about how behavior is at the bottom of the pyramid of money, and nothing works if we can't get our relationship with greed and fear right. And I see that you have interest in behavioral science. So I think it's a great starting point for our conversation. Do you want to talk about it?
Yeah, of course. I think they say that, every decade has some new writer who really emerges and catches the imagination of readers. Morgan Housel is one of them. Though I'll be honest, I have deliberately not read the book because I feel it is like a herd mentality right now to read that book. So learning from what he has also written all through, I've said I'll wait for some time, let prices come down. Not that 200, 300 rupees is going to matter, but it's just a thesis that once the hype comes down, in fact, I am deeply influenced by his thinking and writing. And, I've been reading his blogs almost for now 5-6 years, even when he was earlier with Motley Fool. And all that is written in the book is actually freely available on his blogs. But I don't think when it's free, there is demand. But when you give it a price tag and, it builds some hype, it's a book which has become probably the best-selling book. Now, someone very interestingly said that if you are a believer of what Morgan Housel says, or if you constantly keep quoting him or, posting his comments in your WhatsApp group and all of that, but if you're not investing in index funds, then you are not being true to label. Because after all the reading that you do that he has said, more or less he says the world is unpredictable, future is unknown, behavior matters, costs matter a lot. And he says, ये सब करने के बाद ultimately what matters is choose an index fund and just forget. So on the contrary, I think less than 1% people truly follow that advice, or even now will perhaps follow that advice. So like in everything in life, we like to read a lot, we like to enjoy a lot, but application is always challenging, and more so on areas which are behavioral in nature, like investing. Putting a very disciplined application is not easy. I must admit that, while I do acknowledge that behavior plays a very important role in final outcomes, but this is a very multivariate field of investing. Investing is not like physics or maths or geometry or algebra, where there are fixed equations. It's highly multivariate. It's more influenced by biology, which is our, how does our mind really think and make us act. So on one hand, the landscape is variable and permanently unknown. On the other hand, our behavior is also permanently variable. So when so many variables interplay with each other, the outcomes will only be known on the last day, when we look at our final returns. Till that time, it is all speculation, it is conjecture, it is illusion. It's a combination of sometimes making us feel good, temporarily when our portfolios do well, we feel it is our expertise. Temporarily, it will not feel well. We will feel that, it is a rough patch. But in the end game, who will win, what will win, all will only be known in the end. Tab tak tamasha hai, just enjoy, just ensure that we don't lose too much of money.
No, I mean, you're right, and let me bring in a little bit of stereotyping here that you're truly spoken like a true guju guy, always looking for value. So
True,
since
absolutely.
we are talking about stereotyping, I know I'll say let me bring that point up.
Absolutely.
Another thing, I mean, maybe we can get to the start of your investing journey. And I
Sure.
saw from your Twitter feed that, I can see from your Twitter feed that you're actually a big believer of open sourcing your investing journey. One of
Sure.
the tweet I saw was that you mentioned that you started your career on a salary of about 8,000 rupees per
Yeah,
month. Most
true.
of us have started our career, around
Similar.
that point, similar. So maybe I think that's a good starting point again to talk about your investing journey. And do you want to talk about some framework you
Sure.
have for people who are just starting their career?
I think when you're starting your career, see, let me tell you that my journey has huge strokes of randomness in it. So, in hindsight, after 22 years, I can try and convert it into a framework and make it sound very methodical. But to be very honest, it is randomness. To even say that, I got selected in my first job in a financial services company, because in the group discussion where everyone was talking very, very animatedly and aggressively, I got very scared, and I just shut my eyes because I was very scared and I didn't know how to react. And the head of HR who was doing the interview, she felt that I'm a deep thinker like you introduced me. So she actually at the 13th minute told me that, we have 2 more minutes and I think this gentleman is in some deep thought and we would love to hear his thoughts. And I got to speak for 2 minutes, and which made me get selected. So I'm just trying to highlight that luck plays a very critical role in life, in every phase of life. Having got selected, then of course I gave my best in terms of hard work, sincerity, keeping mind open to learn from everyone. And I must say that I was so blessed to have worked in some of the best organizations in India related to the investment management world. And I must also highlight, Raj, I don't know if you remember, but when I joined ICICI Prudential and I was into the mutual fund advisory division, talking to advisors. So one of the first advisors that I fought for was DSP. Now, I had no clue why I was fascinated with DSP ML in those days. But somehow, whenever I met people like you, Jayesh, and all, I felt that I want to work with this group of people. And that's how my first, interaction with markets started happening. Imagine for someone just passing out of college and getting to, interact with icons like all of you who are on the desk, dealing with the early opening of capital markets, fixed income, and just getting to your. I used to, wait outside when people like you would come out to smoke for 5 minutes and, just give some quick insights. So what I would say is that my learning always has been, and I try to, reflect on that and share with people also, is that, be a curiosity machine. There is great talent around us always, identify which is great talent first of all, and then try and be around them. Keep eyes and ears open, learn from them, learn how to join the dots. I think one very important learning for me is that there are billions of dots in the world. See, the world itself is a dot, like we all know, right? In the large universe and galaxy,
Very
we
true.
are a dot. Within that dot, there are billions of dots which are about markets and investing, and everything about life is like small dots. If you try to analyze each dot, you could lose the plot and get confused. But how to join these dots? How to think that, okay, why is this guy saying what he's saying? Why is this trader forming this correlation that this announcement will mean interest rates will come down? So what is the thought behind that? Is a way of thinking that I started forming very early in my career, whenever I used to see money managers. And some of these were iconic money managers. Some of them were not iconic, but very quiet money managers. One big learning was that sometimes, uh, uh, don't get carried away with glamour. So there were so many good, investment thinkers in the business then and even today who speak less, who don't have flamboyance, who don't have glamour, but have deep substance. So they'll maybe speak few lines.
Or a deep thinker like you.
Or, yeah. So so there are so many like that, and I was really, fortunate to deal with them. And then over my journey of 20 years, I worked in 4 different investment firms. So, got exposed to diversity of thinking. I've realized that diversity is very important again. It helps in shaping our own opinion. So if we can, try and seek diverse opinions and not just, get slotted in one line of thinking, because the world continuously is changing, and new models of making money or losing money are getting discovered. So being aware of that diversity is very important. I was fortunate to deal with clients, investors, large investors who had their own approaches to investing. So that exposes you to some very cutting edge risk and return insights. When I mean by risk is, I've also seen how to lose money. And it took me almost 8-9 years to realize that the first rule to make money is to not lose money. It's not about wanting to make money. It's about, and again, let me push back one more stereotype to you. One of my, oldest Marwadi client, very savvy guy. Like everyone in our industry, I went and asked him one of the days that, sir, aapka risk appetite kya hai? And he almost slapped me. He said, ye mere baap ka hard-earned paisa hai. Mera risk appetite zero hai. You guys learn these in MBA schools and colleges and ask these stupid questions. The first rule of good investing is risk nahi hona chahiye. So that was like a tube light. So I think my advice to people is, surround yourself with the best of people. Be hungry, be humble to learn from all, to learn how to join the dots, and then give your best, and then hope for some bit of good luck.
No, you're right. So, I mean, again, you spoke about an important aspect of luck here. And, again, I'm quoting from the book itself. It spoke about Bill Gates, that, Bill Gates was not only not only a hardworking guy, but he's also extremely lucky because he actually went to the school, which was the only school in the world which got a computer. Had he not gone to the school which has got the computer,
Yeah,
he
would have not got Microsoft.
Yeah, maybe somebody else would have gone there and somebody else would have built a Microsoft. So luck is super important. The other thing, and one of my other favorite speaker is a guy called Rory Sutherland, and he's the Alchemy. He's a great guy, great speaker, and he keeps talking about that we all live in a very probabilistic world, but we're with a deterministic mindset.
Absolutely.
So we all have to think in terms of probability, and that's how we always get better. It's never very sure that something is going to happen. Yes, something may happen, but with the 80% chance, like for example, Biden may win the election, but probably it's 80% or 70% chance, right? But there is always a 20-30% that Trump can upset the election, which happened in the last time as well. So I think there are some of the key aspects you definitely brought in. And you also mentioned about avoiding mistakes, and again I'm quoting Charlie Munger here. We who said that it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid. So you can do so much of wonder by just trying not to be stupid, and you can save so much of money.
Absolutely.
So Any other? I mean, we picked on few of these stereotypes here, and in our conversation so far. Any other stereotypes you want to talk about, which comes to
I
your
will.
mind?
Since you mentioned about Charlie Munger, one of his, comment, which took a lot of time to realize. See, some of these comments or quotes are easy to write, easy to spread around, but to really learn and absorb them and apply them takes a lot of time. And
True.
one of his comments that I've really, got influenced by is that tell me where will I die so I don't go there. I
Yeah,
think
very true.
this is a great risk management principle. So I'll tell you my own experiences. I've been a very bad investor till 2008-9, which is the standard classical way of opening an Excel sheet and looking at which fund has given the best return in the last 1 year, and then putting money there, and then constantly checking it and churning money. And you realize that
So
that
on
is
that, let me
yeah,
talk about, because you brought a very important point. Because if you go to any new age platform right now, all of them are going to show a gold fund as the best investment because of the
absolutely.
last 1 year
Absolutely.
return. So anyway, please go on.
Absolutely. Yeah,
Yeah.
completely right. So, so the thought that, if you know where you will die, and hence if you don't go there, you increase your odds of survival, you increase your odds of living. So at DSP, 2 years back, we were just debating with a very young bunch of colleagues that I have who are a part of our quant and risk team. And I was just asking that how do we apply this in our work? So they said, let's design a fund which first starts by just eliminating risk. So we said, let's study over the last 20 years what companies have. So we started by not looking at which companies have made money, which companies have grown, which companies have given the best multi-bagger returns. We did the reverse. We said, okay, what's our landscape? Our landscape is the BSE 200. In BSE 200, which are the companies which have permanently destroyed value? And then let's study them. So when we studied, you realize what were the common characteristics. They had poor managements, poor capital allocation, high leverage, very high beta of the stock. Some of them had very bad accounting practices. Temporarily they would do well, but structurally they would not do well. So we identified some 25, 30 parameters of companies that destroy value. So then we said, let's experiment that out of BSE 200, just remove such companies. Flag off such companies. And out of 200 companies, roughly around 110 companies just get eliminated permanently or for a long period of time. So just by doing that exercise, and no more rocket science, no more intelligence, no need to understand macro India growth rate or anything, you would beat the BSE 200 by roughly 300 basis points just by
Wow.
eliminating. And this is the power of not making big mistakes. And then after that, you try and again within that narrow down for high ROEs, better debt equity ratios and stuff like that. That can optimize further. But I was just giving an example that one of the important rules in investing is always to ask, wherever I'm going to invest my capital, whether in a fund or in a stock or in an asset class, what can go wrong? Because things will go wrong. Murphy's law will continue to apply. Whenever it goes wrong, it should not derail or disrupt our journey of life, our finances, and our peace of mind. So when things go wrong, can you digest this? If the answer is no, then don't make this investment. Then maybe look at the next option. And you mentioned about gold. Let me give you my personal example. And right now I'm just showing off a bit. So take it with a pinch of salt.
No, go on.
I've never, invested in gold. The only part of gold in my entire life was the small wedding ring that I had, because the whole belief was, stocks can make money. They have dividends, they have growth, they have cash flow. Bonds can give cash flow. Particularly living in a country like India, we get 8-9% coupon on a government of India bond at large. Currently, we are in slightly challenging times where interest rates are too low. Now, if you can, capture these two asset classes, why do you need to give money to gold? But 2.5 years back, I was trying to apply the same principle that, tell me where will I die. So I was looking at which asset class can have some higher degrees of accident. So when you looked at equities were at around 25, 27 times multiple with very, very poor growth rate on corporate profits. So when you invert it, it gives you 4% dividend yield, roughly 4% earnings yield. Then when you looked at government bonds, this was again 2.5, 3 years back, bond yields had come down to 6%. So net of expense, you make 5%. So one asset is giving you 4% yield, the other one is giving 5. When you look at world markets, interest rates now heading towards zero. So gold, which was largely untouchable because it was not giving any cash flow or any coupon or any carry, was now becoming equal to bonds because bonds had started moving to zero globally, not so much in India. But if global bond markets, turn volatile because at some stage the market realizes you can't run at 0% for too long, even Indian bond markets and currencies would take impact. So with that thought, I said that equity doesn't look attractive, bonds don't look attractive. I have no way to analyze the attractiveness of gold, but at least now all three are at par, in terms of poor attractiveness, and I have zero exposure to gold. So let me now add gold. I don't want to add more to bonds and stocks. And more importantly, in bonds, governments can print bonds as much as they want, but they cannot do the same with gold. So, supply is almost infinite in bonds. Every small problem, you have a flu also, government will do a $1 trillion stimulus. Forget COVID. So for every problem, there is more bond supply. But gold, so with that thought, and again, I'm saying in hindsight, it is also some bit of good luck that over 2-3 years, gold has really taken off. And particularly for Indian investors, the whole concept of sovereign gold bonds gives you even a 2.5% coupon. So, you buy a AAA 10-year bond today, it pays 4.5%. So why not get 2.5% from Government of India plus an optionality? So I'm just trying to apply the framework of thinking about risk first in portfolio construction and how it can help in, eventually having some sensible decisions.
No, you're right. And I think that's a great framework to use for anybody, who's looking at investments. And talking about gold, actually, I'm pretty bullish gold, given that the worldwide, the governments are printing so much of money. And you mentioned that gold, bonds can be created, golds cannot be, but, don't challenge Elon Musk. So I was listening to, the Wilkinson's brothers were the original, was there in the Social Network as well. And they had this controversy with Mark Zuckerberg. So they own 1% of the Bitcoin right now, the brothers. So they've turned themselves into a billionaire. So while promoting Bitcoin, they mentioned, and somebody said that why not gold? He said, Elon Musk can actually go to asteroids and mine gold from there.
Absolutely.
Just think of that. Just think of the thinking. I'm just saying
the degree of thinking.
Yeah. So anyway, so he was promoting Bitcoin. I'm actually turning to a little bit of a crypto fan right now, though I don't have any exposure. But yeah.
So I need to learn that. So I will take
I need to learn too. So frankly, you're right. I need to learn too, and that's why I've not invested.
Sure.
And another stereotyping, a lot of people talk about, which is where, they bring in this whole correlation, and, anybody can put any chart and bring in any correlation. I saw one interesting tweet from you, which you said that you wore blue shirt 50% of the time, white shirt 50% of the time, market goes up 50% of the time, market goes down 50% of the time. It's a strong correlation.
Yeah.
There is another actually very interesting website, and, we'll provide the link in our show notes. And one of my favorite correlation in that was the number of movies Nicolas Cage had acted versus per capita consumption of chicken.
Okay.
It's a huge correlation.
Yeah.
So I'm saying the correlations can be so weird and can give a very different, aspects. I don't know whether you want to have any thoughts on that.
So I think the term for this is spurious correlations.
Yes.
And basically, in today's world where data is very easily mineable and spreadable, there are, like I said, millions of data series. Some or the other will always show some connection or correlation, and hence I think in investing two things are important. One, to first be aware that most correlations don't matter, because randomness is a bigger event than correlations. And more than correlations, it is important to look for cause and effect. Are there fundamental linkages in any equation? And then, constantly keep testing it back. So the third dimension I want to bring here, I said randomness. I said, instead of correlations, look for cause effect. And third is look for evidence to keep testing the cause and effect. One, again, a very, very important learning that has come to me after 15-20 years is that the business of investing has become anecdotal more than driven by evidence. So while we deal with a lot of data, but that data is not necessarily evidence. That data is also at times either myopic or, short term, or only to prove a certain point by cherry picking or by, choosing the dates in such a way, or just to feed our own bias. So people may not intentionally do all of that, but these are our own biases. So if I want to start by thinking that the best asset class is equities, for example, the best asset class is Indian equities, for example, I will start by showing Indian equities versus Nasdaq since the year 2000, and it shows that Indian equities has done far better than Nasdaq. On the other hand, if I want to make a case that no, Indian equities are not good, then I'll just change the date to 10 years later and compare from 2010 till today, where Nasdaq has done almost 3 times better than Indian stocks. So it all becomes what are your anchors, what are your biases, and then we seek that data which supports our bias. What I call this as confirmation bias, seeking confirming evidence all through. So this again, is a learning which came through in my, good luck of dealing with good money managers who said, start by looking for disconfirming evidence that what can go wrong in my hypothesis. Why is my hypothesis wrong? And talk to people who have an opposite point of view. So the best way is to, first of all, disregard correlations and rather look for cause-effect relationships. For example, interest rates will go down. And why? So someone could say that, US rates are low and hence Indian rates will go down. But is there really cause effect to that? Have we looked back at 30, 40 years of data? Are Indian markets fungible enough? Are they open enough to absorb global capital and give back global capital? They are not completely liberalized for such correlations necessarily to work. So there are so many nuances to a motherhood statement like that, and we actually did for this particular hypothesis that interest rates in India are correlated to interest rates in US. When you plot the two, data shows 46% map. So it's random.
Actually, it might be lower because, when we had done that earlier, so it is much lower than it, probably like 20-25%.
Okay. So all on it,
yeah. So it actually, frankly, have no correlation. From the US markets.
Absolutely.
Yeah. Sorry.
So, so that again, here is where the need for sensible evidence becomes very important. Taking away the noise becomes important. And generally, they say that out of 100 variables that we try to track, only 3 or 4 are really critical drivers. 96 of them can be noise. So how do we differentiate noise from noise, narrative, and real evidence? Then becomes good art, good principles, good experience, combination of all of that for one to make a judgment that, okay, do I really want to invest on this? Let me give you another correlation which a lot of individual investors get trapped in, that, if a country will grow fast, the stock market will also grow fast. By that logic, China should have been the best performing market world over, but that's never worked. By that logic, India should have been the second best performing market. But then there's a new dimension that it's not just the growth alone, it is how much price you are paying for the growth. If you have upfrontized by paying crazy valuations to enter, then so one cause effect that I have concluded over 20 years now, which has better predictive power 75% of times, is starting valuation. Starting valuations play a very critical role in the overall return of an asset class. And so it's important for every investor to build his or her own anchors like this to take decisions, or look for good advisors who can guide you. Look for good coaches who have understood these equations, so that you don't make accidents with your money.
You're right in terms of, of course, the timing does matter, but, there we again come to the topic of, how do you time the market? Because it's not easy for people to time the market. And, that's what popularized the whole concept of, systematic investment planning, SIPs and all those. So I think that's, I don't know whether you want to elaborate more on that, but this whole timing the market. People say that it's not about timing the market, it's about time in the market, right? So how much time you spend in the market rather than when, time the market, right or not.
So I have a very, important comment to make there. We've all born and brought up hearing this statement that time in the market matters more. What is the reason for that statement is that your money should continue to earn something every day for the longest period of time, is what the concept of time in the market is all about. It does not say that. So I want to add to that line. Time in the right market matters
Absolutely
more.
True.
Time in the wrong market can actually kill you. So if you, and I'll give you data again, that, if someone has started investing in Indian markets in equities in 94, when Sensex first time hit 6,000, Since then till today, the return will be less than fixed income. Will perhaps be 70% offer. So government of India bond in 94 must be giving some 16, 17%.
Yep.
If you had
I
bought
was,
a
I was,
30,
I'm
you
born
were
into
there.
that
You
era.
had just
I'm
started.
born into that era.
Yeah. So if you had bought a 30-year bond then, you would have made 16% CAGR. But Sensex itself has made, some 9 or 10%. Now, most of the money in Indian equities, for example, first time came in the year 2000, which was characterized by the tech bubble. And there were stories and anecdotes that, India will rule the world in terms of software giants and all of that. Sab kuch humne suna hai. But from that day till today, Sensex return is 11%. And you again know that Government of India bond was at 12% that time for a 20-year bond.
Yep.
So equity gave you fixed income returns with equity volatility. Had you just waited for 2 years more, so instead of investing in Sensex at 30p, you just waited for 3 years and invested at 10p. That's the range of Sensex. 10p is the prices valuation, 30p is the bubble valuation. In the real world, it operates somewhere in between. So there are techniques which you can have to time an irrational market. So my learning now is that spend a lot of time in the market, spend time permanently in the market, but be in the right asset class at the right valuation. And you don't need to time it frequently. This could happen once in 5 or 6 years, where markets go to extremes, either you bubble extremes or crisis extremes. And that's where the big rotation through asset allocation should happen. Even coming on SIPs, let me make a comment that there are many investors who, for 5 and 10 years, their SIPs have given poor returns. Or even for 5 years, SIPs have given less than fixed income returns. And then investors feel disappointed that, you were telling me that SIP is the answer to everything, but I've still got FD returns over a cycle. Now, hence, being aware of what can go wrong temporarily. There are phases when SIPs will not work. There are phases when an asset class will not work. And then there are phases when wrong investing by buying. So it's like this, I'm talking to you on an iPad, which should be worth 26,000 rupees. The same iPad I had picked up in Hong Kong 2 years back, 26,000 rupees. But if I end up buying the same iPad again today at 1 lakh rupees, that is a bad decision. Now, irrespective of the fact that I'm going to use the iPad for 5 or 10 years, so time in the market is same. But if your timing is wrong by overpaying, so I would say that time the market to ensure you don't overpay. We have seen that when we overpay crazily, things that don't matter. Take an example, even right now, for the last 5 years, last 10 years, our equity market, for example, has grown profits at 8-9%. What was the thesis for India to get premium multiples, for example, 25-30 multiples, that, India is a growth engine and stuff like that. But that thesis, if it gets broken, then you have to revisit that, okay, let me not, blindly put more and more money if it is not at the right valuation. So those nuances become valuable. And there are product designs which can help solve for that. SIP is one of them. Asset allocation is another one of them. Dynamic asset allocation anchored around valuation changes, around interest rates is another way. So there are solutions for that. Investors should be aware of it.
No, you're right. So you were, talking about timing the market and, again, bringing from the international experience. I mean, to talk about two stocks which hit the all-time high in 99. One was Microsoft.
Yeah.
I think it peaked at about $50 at that time. You know which year it came back to that level? It was 2015.
15
Yes,
years.
2015. And another one, Cisco.
Yeah.
I think Cisco is probably still not at that level.
True.
So from 99. So I mean, I think you brought in another interesting point, right, around diversification. So, which is, I mean, you should never put all your money in one basket. You should, there are asset classes, so you can dynamically change those asset classes through asset allocation strategies, or there are other strategies as well. But you should have an exposure to fixed income. You should have exposure to Indian equities. You should have exposure to a little bit of US, and you should have, of course, have an exposure to the gold as well. So I think diversification is super important. Not just in terms of the asset, also in terms of the putting all your money in on one particular or two particular stocks or not. Yeah, unless and until you're very sure that
Absolutely.
But then you're also relying on your luck on that.
Yeah.
Right. So not necessarily on your technical as well. I think let's switch a little bit from investing to your professional journey as well. So you've been you have had a very successful career so far, and you've been doing very well. You you want to talk about your journey? I've seen you from Prudential days, and and from there to from your DSP, running the whole DSP mutual fund. Do you have advice? I mean, I'm sure some of our listeners will be very young listeners as well.
Sure. So I think, like I said, uh, being in the right company of the right people makes a lot of difference. Being in the right organization very early in your career makes a right impact, because organizations play a very big role in the shaping of talent early in life. One stereotype belief is most organizations are not best. They are not good for employees. So starting off with good organizations makes a lot of impact. I was always taught by my boss, and I'll try to bring investment in that. Uh, he used to always tell me that there are two things that determine the value of a company or a stock: the EPS of the company, which is the company's inherent strength and earning power and profit growth, and the price to earning. Price to earning is in the hands of the market. The market determines your price. Demand, supply, competitive intensity, phase of the cycle, and stuff like that. So in a healthcare crisis phase like this, doctors will get a higher multiple, and some other professions will not get a higher multiple. In a booming economic market, financial services professionals will. So P is not in your control. What is in your control is EPS. And one thing that he taught me was ask this question: that are you growing your EPS every day? Are you growing your EPS every year? So are you yourself enriching in terms of your learning, your thinking, your execution, and second, are you adding value to the organization? Most often the equations are always, everyone says, what do I make from my company? And I was taught that ask this question: that are you valuable to your company? Are you valuable to your investors? Are you valuable to your marketplace? If the answer to all this is yes, you are increasing your EPS. You focus on EPS growth. Someday or the other, P will come to you. You will get the right multiple. Either you'll get the right role internally or externally. So I would just tell everyone that, focus on things that matter to make you a very successful professional. One of our board members, 2 years back, gave me a very interesting insight. He said that, all of you are professionals, but do you know what is the definition of professional? What are your professional ethics that you should bring to the table? And I would urge everyone to just Google and see what does the word professional mean. And it actually means, giving your best to your organization. So I think it's all about give and take, create best results and best outcomes. The second thing that has helped me is, I like to read a lot from, again, diverse sets about things that matter for my business, and about things that matter in any business which can be applied in my business. Now, thinking can make us reading can make us good librarians, but that will not make money for our organization. So then application of what we think and read becomes very important. Execution becomes very important. So I think my two bits of advice would be that, think of what will you give to the organization and to your customer segments, or the industry in which you are. Grow your EPS. That's, one pillar of success. And the second thing is be a learning machine and be an application machine. Learn and apply. Learn and apply. Some very interesting quotes I've always kept in mind is that, to lead, read, to earn, learn. Leaders are generally good readers. All readers are not good leaders, but if you can read and constantly apply at work. And today, unlike in our times when to even learn from diverse sets used to be more difficult because the world was not connected, internet was not yet born. Today, like you mentioned about Rory Sutherland, his course is right now available for 8,000 rupees on branding, behavioral principles, design, and stuff
I mean,
like
you
that.
can learn everything from him in that, right? I mean, so cheap.
Exactly, from the best guy in the world.
Yeah.
So to even imagine Ashwath Damodaran's valuation course is available
It's
within
free on
some
YouTube. He's
yeah,
put up most of his lectures free on YouTube. I
most
mean,
of his lectures.
it's mind blowing that,
Mind
for
blowing.
young guys, it's so
So
much
much
of,
is available.
yeah, available.
So
Yeah.
keeping all these things, today the world has become an open university. Everything is available. So you have to decide what not to get lost in, and with sharp focus and commitment to your jobs, to your careers, to your organizations, to your investors and clients, is a great ingredient for success in my view.
No, right. I mean, talking about ethics, and I want to bring, tell you about one anecdote with Hemendra
Yeah,
Bhai.
yeah,
When we joined our company in '96, and we were like 7, 8 of us, we had a 7-day,
Induction.
Induction to each desk and all.
Yes.
In the end, there was a meeting with Heminder Bhai, and he said only one thing to us, and still in my mind, imprinted in my mind. He said, the only reason you can lose your job in this company is if you compromise on ethics.
Okay. So
That's the only reason.
25 years have gone. He conveys the same thing in a slightly different.
I'm sure.
Yeah.
And let me tell you, if you talk to anybody in the DSP family
system,
they will all talk about the same.
Absolutely.
This is so much of ingrained. That's so much of ingrained. And another thing, I mean, I've frankly worked in I joined DSP Merrill, and they changed many shapes and sizes. And I tell jokingly to everyone that, I've worked in one company, but it changed 6 email IDs. So from DSP Merrill, DSP Financial Consultant initially, to Merrill Lynch, to, BOFA, Bank of America. But I have worked in one organization and actually worked very well. So, there are people, young guys who are listening to this, and, there are various models, but please make sure that wherever you are, you're giving enough time to that organization to make a judgment. Don't just jump around just for the heck of it. True. And there is always a 20% higher payer guy, always there, always, just remember. Absolutely. Right? You have that opportunity, but that doesn't mean that is the right one. So, I'm just adding my bit of advice on this. I mean, you worked with a lot of money managers, in all your, even earlier, and now, you have money managers in your organization as well. Do you want to talk about how people can differentiate between various money managers, and
Absolutely.
what is the key to success for them?
Sure. So, since this is an informal conversation, I can talk about, current and past colleagues of mine who have been very important forces of influence. And that also helped me analyze style. So the benefit of working in, 4 different investment firms is you get to see 3-4 different styles of outcomes. So I've worked in phases where the money managers had a completely growth mindset. And this was also an outcome of the market cycle. So early 2000 and up to 2008, India was, like a very promising growth market. So growth investing was extremely popular. And you saw people who had a very strong growth mindset. Those portfolios did very well. So once you start seeing that doing very well, the error we make is to assume that this is the only way money can be made and this will last forever. And suddenly 2008 happened, and all growth stories collapsed. And the biggest learning was that growth without foundation, growth without cash flows, growth without capital efficiency is recipe to disaster. So we saw how the infra bubble burst. And then in the next 5-7 years, it was value investing which flourished. So I had the benefit of working with Naren, who comes with a value mindset. So his mindset always was buy things cheap, don't overpay. So my big anchor of valuation-based investing, is something I've picked up from him. Now, growth.
Actually, let me bring in. You talked about the mindset, and I keep telling everyone that you are born into a market, and especially true for traders. I've been a trader.
Yeah.
So we were, born into the market where interest rates used to be 15%, and it got down to 4%, and under Dr. Jalan. So we will always have a mindset of being bullish rates. Right, for
bullish
us,
rates, because
right. We were known as being bullish, right? I mean, Jayesh Bhai and us, we were always known as being bullish, including, I mean, some of your earlier colleagues like Rahul Goswami and all those guys. We're all known as being bullish. But somebody who was born into the era of from 2004-5, when interest rates went up for like 4-5 years, back to 9, they had a very different mindset. So actually, I mean, you're right that your mindset. But you have to be conscious about that, But sorry, go on.
So constantly keep evolving. So then you're right that, I worked I joined IDFC when within a span of 2 months, interest rates, 2 weeks, interest rates first moved up by 100 basis points. So, the view was from 5 rates will go to 4. And within 2 weeks, from 5, it went to first 6. So everyone thought it's a value buying opportunity, and 6 went to 7, and then 7 went to 9.5, 10. So you've seen phases, and that's the big learning that markets fluctuate. Everything fluctuates, and there are cycles. So this learning of cycles came, through my experiences and learnings from people like Naren, people like Suyash, people like Manish Dangi, who I was a part of the earlier organization. Then when I joined DSP, one very big learning which came with my, current set of colleagues like Vineet or, Atul on the equity side was the role of quality. That a lot of these things are variable, but something which is inherently durable. So the whole concept of durability is what I learned with a couple of my managers here in DSP. So when I look at Vineet, who for 12, 13 years has compounded capital at 14% CAGR in the small cap, mid cap universe, which is generally laced with landmines. What was that learning? That, companies which preserve their capital well, respect capital well, and don't put too much of money in wrong businesses or fragment their businesses, and are durable, will do well, and they continue to get premium in the market. So this current decade has been characterized by quality, durability, capital efficiency, and these companies which were at X multiples in the last decade are at 2X or 3X multiples. So the market is giving more and more respect to such companies. Now, of course, this again, my biggest trap that I could fall into is to assume that this will also be permanent, and if all the other styles are wrong. So value style, for example, has got decimated in the current decade. Growth style, I would say there is hardly any growth. All growth has become a slow rate of growth. So companies which have high ROCs have become highly fashionable and favorable right now. Now, when will this change? No one knows. Only in hindsight we'll get to know when will things change. My fourth biggest learning from an investment style point of view was the dimension of risk. Um, how companies, when they are showing very fast growth, that growth may not be sustainable because they are taking a lot of risk. So the whole lens of forensic thinking, the lens of analyzing balance sheets. So we've seen in India in the last few years, platforms like INFS and DHFL and all, completely perishing purely because if you go wrong on understanding their balance sheets and accounting jugglery, so that becomes such an important dimension. So we've added a new role in DSP in India called skeptical analyst, whose job is to only wake up in the morning with mandi. Because what can go wrong? What can go wrong? Why are you so bullish? We may not change our opinion hearing that mandi every day, but it keeps us grounded and not get carried away. You may not be aware, but my current colleague who heads our fixed income, Saurabh Bhatia, very young guy, I learned with him why every 5 years the fixed income cycle turns in India. So I always knew that every 5-6 years the cycle turns, which is data, which is long-term history of data. But why? What are those drivers? When does the credit cycle start and when does the rate cycle start? What is the correlation between the MCLR rate and the AAA bond yields? And when they converge, what are the triggers for change? So like I said, the beauty of working with a diverse set of people is constantly learning newer and newer toolkits which can help you become a better investor.
No, yeah, I mean, absolutely right. And, I think there's a great way to put up with the understanding of, how things have moved from growth to value to,
Quality.
high quality. And these are all cycles. I mean, these are all cycles.
Absolutely.
Frankly, I think understanding that many things in life are cycle. Some cycles may be shorter, some cycles are longer. Yeah. Everything is a cycle, right?
Yeah. See, our life is also a cycle, right?
Absolutely, it's a cycle, right? Absolutely, it's a cycle. The other thing, I mean, for people to keep in mind, and another way to look at things is that, and this is again, I'm quoting from Morgan books as itself, is that be a pessimist in your saving, but be optimist in your investing. So a lot of people, becomes very, ultimately it's all fear. It's all flow from greed and fear. But basically, be optimistic in investing. That things do get better, and things things
eventually
evolve and eventually do get better, right? So don't panic. So let's come to the last part. I mean, just some few rapid fire questions, and the first one is, what's your favorite book on investing?
The Art of Thinking Clearly by Rolf Dobelli.
Yeah, that's an interesting one. I think it all starts from the basic of how do you think and make your own framework to do anything.
Absolutely. Framework is a very important word you used.
Investing idol.
I would say Warren Buffett.
Okay. Yeah. I mean, nobody can match his long years of delivering return. I mean, just think of
sharing. And even sharing with people.
Yeah. Just think of it. When he invested in Apple, okay, everybody had, it was made aware to everyone because it was a public investment. He has made $75 billion out of that investment.
Absolutely.
Just think of it, $75 billion out of that. I don't know how much is worth. Berkshire is probably worth about $300-400 billion right now.
Yeah.
30% of their, or whatever, 25-30%
Book.
of their is from that Apple investment, which happened 3-4 years back, where everybody knew that Apple investment is good investment. So
True.
it's so simple.
True.
Life idle.
My father,
Yeah, fathers, yes.
for values of working hard. He used to always say that इंडिया में हम religion के बारे में बहुत ज़्यादा बात करते हैं. We take too many holidays. Our first religion should be work, and those principles have helped me in my career.
Yeah, fathers are all same. My dad used to say, आज की मेहनत कल का आराम, आज का आराम कल की मेहनत. So you can choose. मेहनत तो करनी है. कब करनी है देख लो.
कब करनी है. Back-ended करनी है, front-ended. It's a good tweet you should post.
Yeah. You are, I mean, you're very involved with your son, and you keep tweeting about it. And I know that you do SIPs on his birthday also, and I think he's some kind of a guru to you as well. So, what is the best piece of advice you've learned? I mean, now you talked about your dad. Now from your son, what is the advice you got from your son?
I think be free, be carefree. Don't take too much of stress. Enjoy.
Okay. Yeah. That's why he's like what, 12, 13? How old is he now?
He turned 14 this year. Just recently. A few days back. Yeah.
That's interesting. So, I mean, thanks, Kalpen. I mean, really appreciate your time. And, I look forward now, since, we are also stepping into this world of investing and hope to give back to people. Look forward to, understanding.
So, Raj, I want to say that you were an icon for me. It used to be like a wow to me whenever you would say that, okay, I'm willing to meet you. 5 minutes hai, aa jao. So I'm so happy.
No, that's nice and very humble of you. But let me tell you, that's not true. But yeah, go on.
No. So it was very because there's so much to learn from people like you in those days, and that our markets were not very efficient, and very few people like you had the pulse of bond markets. So I'm glad that you, after a long career journey, professional journey, are bringing back all your valuable insights and experiences in a very scalable way and in a very durable way to guide investors to deal with their money. And it's not about shortcuts or one quick fix. The way you introduced your platform, also Multipie, I hope it helps investors also multiply and compound over long periods of time. So wish you also all the best. And we need a lot of professionals like you coming back in the space.
No, I mean, thank you so much, Kalpen. You put in those beautiful words, and we're also looking forward to add to bring in all those years of experience, and add to people and give back to the people. I mean, a lot of people have helped us in our journey, and hope that we can help a lot of other people in their journey as well, both as a mentor for anything related to career or as an investment as well. So looking forward to add to them. So thank you so much. For our listeners, I mean, you can find Kalpen on Twitter. If you're not following him, you do it right now. His handle is simple as @Kalpen Parekh. So please do follow him. And please do share or comment on your thoughts on the episode. And next time, bring your friend as well. So thank you so much, guys. See you next time.